Assalamu alaikum friends, welcome to SBR revision series for September 2021, and today we are going to cover the most important standard for your SBR exam. Yes, it is business combination IFRS 3, the much awaited standard that all of you have been waiting for. And I have got many messages, many emails, people asking me for IFRS 3, IFRS 9. So here I am. The reason why there was a delay in this standard because there are so many standards here, and it's a long standard. So I had to take some time to integrate everything into one single piece so that I can. So everything is covered in this one video. If you see this one video, you have understood everything about group accounting. That's the reason I have taken so much of time to make this video because it's from different areas. Okay, so hope that you find this useful. Okay, so business combination IFRS 3 definite question number 1 for your SBR for 30 marks. Okay, and it includes various chapters from your textbook. Okay, it's not just single standard, it has many standard in it. So let's start with business combination, and this is calculation plus your discussion. It is going to cover both aspect of it, not just calculation. So even if it's for 30 marks, don't think the 30 marks is entirely for calculations. Okay, so first we are going to go through the overview of the paper. There's be a paper relating to this standard, business combination. What is business combination? Because if it's not a business combination, you cannot use IFRS 3. Okay, if it's business combination only, IFRS 3 comes. We have some certain test to do that, to know whether it's a business combination or not. Accusation method. If it's a business combination, we use accusation method. There are some steps that we are going to follow. Goodwill impairment. Okay, because when we have acquired a subsidiary, we are going to calculate a goodwill, and that goodwill has an impairment also, so that also we have to calculate. Then we are moving towards some basic workings. These are the workings that you need to do for your SBR exam relating to your statement of profit and loss and statement of financial position. Step accusation, when you have acquired in stages, not in one go. Disposal of subsidiaries where control is lost, you're disposing and where the control is lost. Presentation of disposal, when you're presenting, when you're disposing, how do you present in your statement of financial position, statement of profit and loss? Control to control scenarios, that means whether you buy or whether you sell subsidiary in stages, that too control is not lost, it is retained. Then what is the accounting treatments? So you can see this is a very big topic, it will take so much of time. Okay, it will take a lot of time for me to go through all those things, right? So let's start with the overview. In your SBR exam, question number 1 will always test group accounting, no doubt about it. So IFRS 3, in and out you have to know about IFRS 3. SBR exam is likely to require discussion of issues. Remember, you have to discuss the issues also in the consolidated financial statement, not just calculation. And mostly they tell you to produce extracts, not the whole consolidation process. You don't have to go through the whole consolidation process. They will never ask you full consolidated financial statement, you can be assured of it. They will only ask you the extracts and discussion of issues. Okay, then impact of different types of share purchase and share sales on the consolidated financial statements. What's the impact? So from your exam kit questions, these are the questions. Luke Lloyd, Banana, Trailer, ZP Ashante, I have completed all, is under my SBR revision kit solution. You will find it out there. So it's all there, and in fact I have completed all the questions relating to group accounting. That was the number one thing I've done when I started with SBR. I have first finished all the questions. From the lectures also, my all group accounting lectures are also there. You will find out, it's there in my SBR lecture playlist. You will find out there. So let's start with the business combination. What is a business combination? Okay. So IFRS 3 states that accusation method is used to account for business combination. Okay. So business combination is where acquirer obtains the control of a business. You have acquired something and you are obtaining a control of that. It's a business. That is known as business combination. Okay. So there's some test that you need to do, because sometimes when you're acquiring something, it might not be a business, it might be just an asset. Often this question comes in your exam also, whether it's a purchase of an asset or a business. Because if it's a purchase of an asset, it will be dealt under, if it's a tangible asset, IS 16, if intangible asset, IS 38, or financial asset, IFRS 9. But if it's a business combination only, then IFRS 3, then only you consolidate. That's the reason. Okay. So this things you don't have to do calculation, but for discussion purpose you need this points. One is concentration test. You do a concentration test to check that it's not a business. Not a business. You don't do concentration to test to see whether it's a business or not. You do to see that it's not a business. You want to confirm it's not a business by doing this concentration test. It's an optional test, okay? It's not compulsory that you have to do this test. It's an option. If you want, you do. If you don't want, don't do. Okay, so an optional concentration test can be used to assess whether an acquired set of asset is not a business. Not a business. That means what? To find not a business, you have to do a test now. Number one, first. Okay. So how do you know whether it's not a business? The acquired assets, the assets that you have acquired are not a business. You're understanding? It's not a business, it's an asset. How will you know it? If substantially all of the fair value of the total asset acquired is concentrated in a single identifiable asset or a group of similar identifiable asset. If you see the value of a single asset or a group of similar asset, most of the fair value, substantially all of the fair value is in that asset, one particular asset. You're understanding? So it is a acquisition of an asset, not a business. Because it is focused, it is concentrated in one asset, the fair value. The fair value of the total asset, all the asset if you check. And most of them, substantially, it is concentrated in one particular asset out of that total asset. It is not a business combination. It's acquisition of an asset. Now the second, there are some elements of a business. To know that it's a business should have these three elements. What are the three elements? Okay. If but before going to the three elements, if the concentration test is not met means it is a business. That means it's not a met means it's a business. Because why are we doing the concentration test? To find out it's not a business. Okay. Not a business means it's an asset. If it is not met means it's a business. Okay. I hope you're not getting confused over there. If the word was like this, if the concentration test is met, that means it's not an asset, it's not a business, it's an asset. But here they told if a concentration test is not met, that means it's a business. From the concentration test, it has been concluded that it's a business. Okay. Or if the test is not applied, that means you have not applied the test only. Okay. But it's a business. Okay. A detailed assessment is required to assess if a business has been acquired. Okay, if you are not doing the test, then you have to do some assessment, detailed assessment, to check whether it's a business or not now. So these are the three elements of a business. It should have an input, it should have a process, it should have an output. I have highlighted it in bold. If these three things are there, it's a business. Okay, and definition is not needed. It's easy. Input means input. Okay, process means you have to do something to the input, and finally the result to create it into output, right? So input, process, output, all these three together, it is a business. You're acquiring an input, process, output. If you're acquiring all those three, it's a business. Okay, so now we have concluded it's a business. After that comes the acquisition method, because business combination have to use this method. So under this method you have to go through 4 stages. Number one, it has 4 requirements that you have to go through. Acquisition method. Number one, you first have to identify the acquirer who have acquired the business. Number two, at what date the acquisition took place. Number three, recognize the subsidiaries. Sub means subsidiaries net assets at a fair value. At fair value, everything is at fair value for IFRS 3. That's a good thing. No need to memorize everything. Everything is at fair value. So net asset of the subsidiary is also at fair value that you have to recognize. And finally, you have to recognize a goodwill and NCI. That's what we have been doing. Because subsidiary, when you acquire, goodwill also you have to recognize, NCI also you have to recognize. Okay. Now, starting with the first step, we are going in depth, in detail now. Identify the acquirer. How do you identify the acquirer? So acquire is the one who have a control over another entity. It is assumed that he has a control. How do you know he has a control? It is normally more than 50% is taken as a control. Okay. In terms of percentage, more than 50% is a control. That means more than 50% he has acquired a subsidiary. And acquirer is a person who has transferred the cash. Remember, in the past paper, I don't remember the year, but I have seen a question where they asked this thing, that who is the acquirer, right? Because there were some 2 or 3 companies given, and out of this, who has acquired this company? Who is acquired? There was a question like this recently on this method only. That's the reason why I have included this in this video. Even though it looks like that why we have to go through this identify, acquire, acquisition date is given, still you have to go through this. Because there has been a question recently, very recently, there has been a question in the past paper on this 4 steps, especially identifying the acquirer, this first step. Okay, so the one who has transferred a cash or any asset or shares, he is the acquirer. Other factors are also there to know who is the acquirer, such as which entity's former management dominates the combined entity. Whoever dominates it, the combined entity, he is the acquirer. Which entity's former owner? Former owner means before the acquisition, before this business combination, have the greatest number of votes in the combined entity. That means whoever has the greatest number of votes, let's say 60%, 70%, he is the acquirer. Which entity was bigger? The one who has acquired or the one who is being acquired? Identify the second step, second requirement, identify the acquisition date. We are done with the acquirer part. Okay, so these are some things. Identify the acquisition date. Acquisition date is normally given to you, okay, for calculation purpose. But if they are asking it for a theory part, then it is the date on which the parent obtained control over the subsidiary. Sometimes they might not just write the acquisition date, they might just write sentences like this, that this is the date parent has got control over the subsidiary. That means that's the acquisition date. Okay, next, third, recognize the net asset. You have to recognize the net asset at fair value. Okay, net asset means all the liabilities, all the assets of the subsidiaries at fair value at the date when you have acquired, at the acquisition date. The acquirer must measure it. Fourth, recognize goodwill and NCI. Okay, so when you are calculating goodwill, you need 3 things. One is the purchase consideration, at what amount you have purchased the business combination. That also should be measured at fair value. Remember, these things are given for your theory, for your discussion. If they ask you, at least you can write that if you're calculating goodwill, purchase consideration has to be measured at fair value. Then comes your professional fees. If there are any professional fees, you have to expense. It will be as an expense. That you cannot take it as a purchase consideration. That will be as an expense. NCI can be measured in 2 ways. Either at fair value, either at proportionate value, proportionate method. Fair value means it is also known as full goodwill method. That means it includes the goodwill of the parents also the NCI also. Okay, and proportionate share of fair value of subsidies net asset means only the parents' goodwill is there. Okay, that is known as partial goodwill method. Now, goodwill impairment. So, we calculated goodwill just now under when we have acquired a business combination. So, we have to impair it also. Okay, and remember we have went through IS 36 impairment, right? Generally, that impairment covers impairment for intangible assets, tangible assets, any type of assets, impairment is there. It covers all assets. So goodwill is also part of an asset. Okay, so this also needs to be impaired. So most of the impairment rules that we have done, they are similar here also. Carrying value minus recoverable amount. Recoverable amount higher of fair value, less cost to sell and value in use. So these things are similar. Okay, so goodwill, when it comes to goodwill, what happens is examiner makes it easy. They don't tell you to find that impairment loss. They themselves already tell you whether it's impaired or not, and they give you an amount also. So it's easy for you. Just take that impairment and deduct it from goodwill. Okay, so this also has to be tested annually for impairment. Even though goodwill is an intangible asset, goodwill has an exception under IS 36. We went through that. No, I think under IS 38, under intangible asset, that goodwill is not amortized. Okay, it's not amortized like other intangible asset. It is only tested annually for impairment, especially when it comes as a business combination, right? So this goodwill is that. And goodwill does not generate independent cash flows. Having a goodwill will not give you cash flow. From there you cannot incur any cash flow. It has to be used with something else. For example, it's a part of a subsidiary, so that subsidiary is a cash generating unit. Okay, it is tested for impairment as a part of cash generating unit. For your exam purpose, they have made it easier. This cash generating unit is a subsidiary. Okay. So whether NCI was measured at fair value or the proportionate method, this will have an impact on your impairment review. Significant impact on the impairment review. And remember, sometimes they might ask you also what is the impact. So you have to explain in discussion, in writing. One is fair value method, the other one is proportionate method. If it's fair value method, that means full goodwill is measured. That means impairment. Okay. So how are you going to find the impairment? You add that goodwill with your net asset because it included both parents and the NCI share in that goodwill. So nothing to do, just take that goodwill, add with your net asset and then compare with your recoverable amount. Because you have to find the carrying amount of the asset, no? So carrying amount of the asset, how will you find out? You have to add that goodwill also with the net asset of the subsidiary. Then only you compare with the recoverable amount. Coming to the proportionate method. Proportionate method, you just cannot take the goodwill because it only includes the parent's share of goodwill. You have to include the NCI share of goodwill also to compare with the recoverable amount. That's the reason we have to gross up. Okay. We have to gross up that goodwill, add it with the net asset, then compare with the recoverable amount and find the impairment review. This is the reason we do this, grossing up. For those people who ask me why we have to gross it up, because in the statement of profit and loss we are only showing it for the parent, right? So why to add gross it up again? Because anyway, whether we gross up or not, we are anyway showing it for the parent under full fair value method also for this purpose. Because for impairment, to calculate impairment, you need both the NCI and the parent's share of goodwill to find the impairment. You cannot just take one person and then compare with the recoverable amount and find the impairment. No, that's the reason we gross up. Okay, to include the NCI share also before we calculate impairment. Remember, before impairment comes, gross up. So proportionate method is little bit that is there, but fair value is easier. Okay, just take the goodwill as it is, add with net asset, compare with recoverable amount and find the impairment. Now there are basic workings. So these are some workings that we are going to go through. First, let us start with the consolidated statement of financial position. So when you are told to consolidate, you goodwill, okay? So goodwill, as you can see inside the bracket, it's known as working number 3. So it could be any number 1, 2, 3, depending on your this thing. Okay. Mostly it is working number 3 because working number 1 and 2 will go see later. We'll see that order. Okay. Mostly goodwill is working number 3. But if the number changes 4, 5, it does not have so much of impact as well as your goodwill is correct. So whenever you have calculated that goodwill will now come in the statement of financial position. Asset P plus S, that means parents plus the subsidiaries. Asset you can add. Total asset. Share capital, only the parent. You are not adding with the subsidiary. Then other components of equity, we have working number 5. Okay. Wherever workings are required, just put in bracket beside it working and the number you can put accordingly. Retained earnings also working number 5. NCI working number 4. So this all will go in the statement of financial position, total equity and liabilities, parents plus share and total equity and liability. So this is how your consolidated statement of financial position will look like. But in your exam, okay, I don't know whether I should say fortunately or unfortunately, you will not be asked this full consolidated statement of financial position. But they might tell you to do extracts. Extracts means they might tell you to do only show equity and liability part, or only the asset part, or only the goodwill part. So for that case, it's better to have a knowledge of full consolidated statement of financial position as well as full consolidated statement of profit and loss and other comprehensive income. That's the reason. Okay. But otherwise, you don't have to prepare the full thing. Now let us go to the workings. Small working. Working number 1, start with the group structure. Even in your exam, this is the way you have to do. Okay, I have made it very easy for you. And in that order only, in what order you are supposed to do in your exam. So first, always start with the group structure. Okay, and examiner always give you 3 companies. Most of the time, that's what I have seen. Okay, they might give you another company also 4, but they will not give you 5, 6 companies. Okay, maybe 2 or 3. So let's say A have acquired B and C, 2 companies, 2 different subsidiaries, and both are subsidiary because one is 70%, one is 80%. Both are above 50%. So I know it's a subsidiary. Both are subsidiary B and C of A. So this is the group structure that you need to do, okay, in your exam. Working number 2. The reason why this group structure, because it helps you to show whatever you have read in a paragraph, in sentence. It's easy to show in a diagram like this. It's like a summary, so that when you see it in front of you, you know, okay, this is 70% subsidiary. So this is how you calculate. Then working number two. Working number two is always net asset. Okay, net asset of each subsidiary. There are two subsidiaries now. Okay, so this is, I'm not showing two times for both subsidiary. For one subsidiary, if you know, it's for all the subsidiary, this is the same formula. Make three column. Okay, and these things you can do in Excel, by the way. Okay, you can do it in Excel if you want, for calculate addition and deduction, that's some function, and if you want, then you can do it in Excel. Otherwise you can just write it in Word, and you can use your calculator to find the addition of it. Anyway you can do it, because it's on a CV platform. So first column will be, you'll be writing your description. Second, at acquisition date. Third, at reporting date. Don't forget this. As it is, I'm showing you that with no changes. Then you have to write that dollar sign. Okay, dropping down 3 zeros, so in thousands. Starting with equity share capital, start with equity share capital. This equity share capital will be of the subsidiary, because now we are dealing with the net asset of the subsidiary. And subsidiary share capital will not change. It will remain same both at acquisition date also, at the reporting date also. Next, we have other components of equity. This will change. This will change. Okay. At the reporting date, they will give you a statement of financial position. Whatever amount that they have given there, that amount you have to take as at the reporting date. And if they give you some amount in paragraph, in sentences later on, that amount you have to take at the acquisition date. Okay. Retained earning also the same way, like other components of equity. It will change. Okay, it will increase only at the reporting date. Fair value adjustments. Remember, they give you some fair value adjustments also related to some one asset. It could be tangible, it could be intangible, it could be financial, anything, any asset. But usually they give some fair value adjustments related to asset or a liability. Mostly it's asset, mostly. That's what I have seen, but it could be for a liability also. That's why it could be an addition or deduction. If fair value goes up, add. Fair value goes down, deduct. Okay, and this also will have impact on both. It will be same at the date of acquisition, at the reporting date. And post acquisition accounting adjustments. Okay, this means this is a provision for unrealized profit on sales made by S. That means subsidiary is making sales to parent. Okay, if a parent is making sales to subsidiary, it will be recognized in the retained earnings of the parent, not here, because this is for net asset of subsidiary. So subsidiary's point of view we are writing. So if the subsidiary is making a sale, that means he is the one who has to recognize the profit, no? So it's an unrealized profit, because this is an intra-group sale, it has to be eliminated. That's why you are making this adjustment at the reporting date. Nothing comes in the date of acquisition, because this is post acquisition. At the reporting date only it will come, after the acquisition. Okay, if there are any adjustments, you have to make it here, add or deduct, because it's any intra-group sales, intra-group purchases has to be eliminated on the consolidation. And finally, we get the net asset at acquisition date, at reporting date also. Sometimes fair value adjustment you can get as a balancing figure, because they might give you the net asset at the acquisition date, and obviously they will give you the equity share capital, other components of equity, retained earnings. So what's left is fair value adjustment. So you can find it as a balancing figure. Sometimes they will give you the fair value adjustment and balancing figure. Sorry, fair value adjustment is given and net asset at the acquisition date you have to find out. Okay, so it could be in either way. Be careful about it. But at the reporting date, net asset they will never give you. That you have to find out. Okay. So whatever you can see 2W3, that means it will go to working number 3. So whatever the net asset you get at the acquisition date, that X will go to working number 3 under goodwill, because for goodwill you need this. Okay. And how do you find the post acquisition profit? The X that you have found under acquisition date minus the X that you have found under reporting date. The difference between these two. This post acquisition profit. Now let us go to working number 3, goodwill. So goodwill, this is the way you find out. You first start with the fair value of consideration. It's given to you. Sometimes you have to find out also if the consideration is not in cash. Sometimes it might be in form of shares or some other way. NCI at accusation. It could be fair value, it could be partial method. Whatever it is, add it with fair value of consideration and deduct your net asset at accusation, the one which you have got under working number 2. Okay, at accusation, not at the reporting date net asset. Everything is fair value. Finally, you get the goodwill. And if there's an impairment, deduct it. If there is no impairment, leave it. Whatever goodwill you have got, that goodwill only you can carry forward. But if there's an impairment, deduct it and then find the goodwill at the reporting date. Now let us go to NCI, working number 4. After goodwill comes NCI. So follow this order only. Working number 1, group structure. Working number 2, net asset. Working number 3, goodwill. Working number 4, NCI. Working number 5, retained earnings. And working number 6, some other things like unrealized profit or any other thing if it's given. So NCI, you first start with accusation. NCI at accusation. This could be at fair value or proportionate method, anything. It will be given to you what is the policy of the company. Okay. So this NCI you will get it from the fair value goodwill calculation. The NCI that you have taken there, that goodwill that NCI only you have to take. Then you add post accusation reserves. I have told you how are you going to get the post accusation reserve? Net asset at reporting date minus net asset at accusation. Okay, take NCI percentage, 10%, 20%, and then deduct any impairment that is only for NCI. Take the NCI percentage of the goodwill impairment. If fair value method only, why? Because fair value method only has both NCI and parent in it. So just take the NCI percentage out. But if it's a proportionate method, no need to do anything with it because it already only includes the parent's portion there. NCI portion is not there. So no need to write it under NCI. You can just ignore it. But if fair value method is used for NCI calculation, for goodwill impairment, you have to take the NCI percentage. Okay, and deduct it and find the NCI. Whatever NCI you get will go to statement of financial position. Whatever goodwill you got will go to statement of financial position. Group reserves. Reserves has two things. One is retained earnings. The other one is other components of equity. Okay. So working number 5 is retained earnings. You first start with the parent company. Parent company, whatever the retained earnings they have, take it 100%. Then with this, if you have two subsidiaries, both the subsidiaries retained earnings you have to add according to their share. So group share of the post-acquisition return earnings. Post-acquisition return earnings means net asset at reporting date minus net assets at acquisition date from working number 2. That's why working number 2 is there. And you have to take the group share. Let's say you have acquired 70%. So 70% into that post-acquisition profit. 80%, 90%, whatever it is. That percentage you have to take. You cannot take 100%. Only the parent you are taking 100%. If there is any goodwill impairment, remember, only the parent's goodwill impairment now you will deduct. Working number 3. Only the parent, not the NCA. NCA you have already taken in NCA. PURP if P is seller. I have told you when we were calculating net asset that when S is selling, subsidiary is selling, he is deducting it from there, net asset. But when P, parent is selling to subsidiary, because P is the one who is selling, whoever is selling, he or she is recognizing the unrealized profit, so it will be deducted from him. That's why under retained earnings, if P is selling, it will be deducted. If S is selling, it will not be deducted from retained earnings, it will be deducted from NCI in your working number 2. So just see who is the seller always when it comes to deduction for provision for unrealized profit, PURP. Finally, this X, the X in bold will go to statement of financial position. Then we have other components of equity. And remember this P, parents percentage, only fair value method is used, because for the proportionate method no need to take the parents percentage, as it is you can take. Okay. Other components of equity, sometimes they might give you, sometimes it might not be there. If it's not there, no need to worry. If it's there, then you have to do working, and workings are pretty simple in other components of equity. It's not so lengthy. So parent companies are the components of equity. With that, you add the subsidiaries. Same way how you have done for retained earnings. Here is just the other components of equity. That's it. So add the group share of their post-acquisition other components of equity. How are you going to get the post-acquisition other components of equity? Other components of equity at the date of reporting minus at the date of acquisition. From working number 2, you can take. Just deduct and find. That's it. This only will go in the statement of financial position. Now, Move your mind towards profit and loss and other comprehensive income. Consolidated statement of profit and loss and other comprehensive income. We are over with statement of financial position. Here, number one, group structure. Number two, set up the pro forma. There's a pro forma you need to set up. Number three, complete that pro forma. Wherever elimination is there, eliminate it. Wherever addition is there, add it. Then calculate the profit and TCI. TCI means total comprehensive income. Both profit and total comprehensive income, which will go to the NCI, you have to calculate. Okay, so let's start with step number two. Step number one is nothing, group structure. It's the same that you have done for your statement of financial position. A is acquiring B, A is acquiring C, 70%, 80%, that's it. Because sometimes they will give you only two of the one, either statement of profit and loss, either statement of financial position. Very okay, I've never seen that they are giving you both the places. They will never give you like that. Maybe one of this two. So it depends. If you are given statement of profit and loss, here also you have to do group structure. If you are doing statement of financial position, there also you have to do group structure. Okay, group structure has to be step number one, working number one. No doubt about it. So let's start with the consolidated statement of profit and loss and other comprehensive income. Step number two. So revenue. How we have done earlier for statement of financial position, line by line we are consolidating. This one also line by line we consolidate. P plus S means parent plus subsidiary. So you start with revenue, cost of sale. Gross profit you don't add. Gross profit you take after you deduct cost of sales from the revenue. Then operating cost add. Operating profit don't add. Finance cost add. Profit before tax no need. Tax add. Profit for the period. I have given it as a Y. Okay. It's not over, guys. The continuation is on the next right side because I don't have space down there below. So it will start with OCI. After profit for the year comes other comprehensive income items. That is known as OCI. I've used the short form there. Okay. Here also you have to add both the parent and the subsidiary. And then comes TCI, total comprehensive income. Please remember the structure of it. What comes after what? That order is also important. You cannot write OCI before profit. And you cannot write TCI before OCI. So profit plus the OCI is TCI, which is known as Z. So Y X Z. And profit attributable. This is how you need to do, okay? Finally, you have to conclude it like this. So profit attributable to equity holders and NCI. For equity holders, no need to do any working. It is the balancing figure. That means you only have to work out on the NCI part. That is in step 4. Okay, and same for TCI, which is known as Y. And for TCI also same way. Equity holders NCI, which is known as Z. Remember, it is not the OCI that is attributable. It is the TCI, profit and TCI. Please don't go and take OCI, attributable to equity and NCI. Okay, so this is the format. This is also same like statement of financial position. They will not give you the full statement of profit and loss account. You might just have to do extracts, but focus more on the end part, the last few parts, especially the profit attributable to C, attributable to this part. Okay. Next, step number 3. That pro forma is not complete. Few things are not included, such as parent and the subsidiaries income and expenses add line by line, and also OCI. And if the subsidiary has been acquired mid-year, that means in between the year you have acquired a subsidiary. Subsidiary was not there for the whole 12 months, the whole year. Then prorate. Prorate. Let's say you have acquired the subsidiary in the middle of the year, only for 6 months. So that company is only your subsidiary for 6 months, so you can only consolidate for 6 months. That means any revenue, any expenses, any OCI items that you are taking to consolidate with the parent, only 6 months you have to take. You have to take 6 months for all the income expenses and then add with the parent. You understanding? Then you are consolidating. For income, expense and OCI item also. Because income expenses anyway goes in profit and loss and OCI. Then if there are any intra-group, that means among the parent and the subsidiary, income, expenses, unrealized profit, eliminate. Eliminate it. Eliminate means if it's an income, deduct it from income. Expense, it will be deducted from expense because it's not an expense. It's like that. Then intra-group transactions as well as any dividends received from the subsidiary. If the parent is receiving any dividend from the subsidiary, eliminate it on consolidation. Okay. So these are some additional things that you need to do. Then we are moving to step 4. Very important step number 4. So make two columns. One is for profit, one is TCI. Please again, not OCI, TCI. After you add OCI with profit. Okay, and don't forget to take the dollar sign, the currency, always keep it. Okay. You start with the profit and the TCI for the year. But if it is at the mid-year accusation, that means it could be for 3 months, they have been subsidiary 4 months, 5 months, does not matter. Prorate. Prorate that profit and TCI that you are taking. For example, profit is 10 million. You have been subsidiary for 3 months only. So 3 months of 10 million you have to take. 3 divided by 12 into 10 million. And for same for TCI also. PURP, provision for unrealized profit, if S is the seller. That means subsidiary is the seller. Then deduct it. Okay. Now, why not if P is the seller? See, if P is the seller, no need to do any adjustments there because we are only working on the subsidiary part, profit and TCI of the subsidiary for the year. So we are only working for the subsidiaries profit and TCI. That's why this comes as a profit, PURP for the subsidiary. This needs to be deducted from the subsidiaries profit. That's the reason we are only taking the if S is the seller, if the subsidiary is the seller, not the parent part. Okay. And excess depreciation and amortization. If there is any excess depreciation or amortization, because fair value movement may be, right? Fair value changes and all, if anything is there, because of that fair value movement, there is excess depreciation or amortization of intangible asset, it needs to be deducted from the profit of subsidiary. Because that excess depreciation is because of the fair value movement due to business combination. That's why from subsidiaries profit only you have to deduct. Goodwill impairment also you have to deduct, but if only fair value method. Fair value method. Because if it's a proportionate method, then it only includes the parent's part. Then why, no need to deduct it because this we are working to find the NCI. Profit and TCI which will go to NCI. Okay. And finally multiplied by the NCI percentage. After you do everything only multiply by the NCI percentage. Don't take line by line and start multiplying by the NCI percentage. Let's say NCI is 20%. Whatever amount you get multiply 20% and that amount is known as profit or TCI attributable to NCI. Don't take it together. Profit will be in one column, TCI will be right next to it. Okay. This only will, that X in bold, the last X will go into your statement of profit and loss. Okay. And the balance you can find for the parent. Now let us move on to step accusation. Up to this point, there were no change in your group structure. You have acquired a subsidiary, he stayed your subsidiary for the whole year, now the changes come. Step accusation. What is step accusation? Acquiring control in stages. You are not buying that subsidiary in one go. Let's say first you bought 60%, then now you are buying another 20%. So he is still your subsidiary, but that percentage increased from 60 to 80. So you are acquiring the control in stages. That is known as step accusation. Accusation in steps. Now, accusation accounting is only applied at the date when control is achieved. Let's say initially you purchased 40%. That time he was not your subsidiary. You cannot use accusation accounting then. But later you bought 20%. So 40 plus 20 60%. At that time you gained control. That time only you have to. The second time when you bought that 20%, then only you can use the accusation accounting. Accusation accounting means you will start calculating goodwill and CI, everything. So at the date the control is achieved, these are the following things you need to do. Remeasure the previously held equity interest to fair value. Let's say the previously equity interest was 30%. It was a associate, no? 30%? Less than 50%. It was not a subsidiary. So now because you have achieved a control, you have to remeasure it at the day when you have achieved that control. The first time when you bought it, it was many years back. But recently when you bought the second purchase, you got a control. So you have to remeasure that to fair value. Second, recognize any gain or loss. Okay, for the gain or resulting in recognize any resulting gain or loss in profit or loss for the year, or in OCI if the shares were fair value through OCI. Because when there's a change in control, remember when you didn't have a control and when you're acquiring a control, even when you're losing a control also, there will be a gain or loss that you have to calculate. Okay, there will be a gain or loss, and this gain or loss will normally go to profit and loss account. But under one condition, it will go to other comprehensive income. What is that condition? When your shares are through fair value, designated as fair value through other comprehensive income. Because this is about equity investment we are talking about. Because equity investment, when you have designated it as fair value through other comprehensive income, you cannot recycle it to profit and loss account. That's the reason. Any gain or loss will also go to OCI for the equity shares that are fair value through OCI. Definitely this you will understand it better under IFRS 9 when we go through equity investment. Fair value through OCI, fair value through profit and loss account and all those things. Here you don't need that much of knowledge. You already need to know that if OCI, if shares through OCI, then OCI, otherwise profit and loss. Third, calculate goodwill and NCI because you have got that control. That means he became a subsidiary. You have to calculate goodwill also. You have to calculate NCI also. Okay. Now, these are the procedure that you have to do to calculate goodwill. Because this is a step acquisition, previously you didn't gain the control, now you gain the control. So fair value of previously held interest. That interest could be an associate, that could be a financial instrument. Now you have to find the fair value of it. Next, any consideration, fair value of that consideration you have to add. But what consideration? Not when you bought it first time, second time. Fair value of consideration for the additional interest you have to add. Because at the second time only you got that control. And more than two times they will not give you. Don't think that it's 10%, then 30%, then 40%. No, they will not give you like this, only twice. NCI at accusation you add. Okay. And fair value of net asset at accusation deduct. And finally, you will be left with goodwill at accusation. Okay. Now, let us move on to the disposal of subsidiary. So this was accusation of subsidiary where we are gaining our control. This is loss of subsidiary or disposal of subsidiary where control is lost. Opposite of it. So everything is same, just it is opposite now. Here control is lost. That means now you are not being a subsidiary anymore. You were a subsidiary, now you are not being a subsidiary anymore. So you have to stop consolidating from that day onwards. You consolidate income and expenses up to the disposal date, not after that. After that, what do you have to do? Because when you dispose the subsidiary, you have to now de-recognize all the assets, all the liabilities, the goodwill, NCI of the subsidiary. And find what? Profit and loss on disposal. You have to calculate a profit and loss on disposal. And mostly in your exam, there's a pro forma for this, which you need to know because they usually ask a question on this, profit and loss on disposal, or whether profit and loss should be calculated or not, which we are going to cover shortly in few minutes. Then recognize any remaining investment. Definitely, if you are not selling entirely, if you are still having something, you just sold few, maybe 50% you just sold, the balance you have to recognize that balance at fair value. Okay, and find that balance and account for under the relevant accounting standard. So now let's say he was a subsidiary, but now he became an associate. Okay, less than 50%. Between 20 to 50%, now you will use equity method under IS 28 because he is now an associate. Or if he's having a less than 20% now, you have to use IFRS 9. Okay, it is now a financial asset under IFRS 9. The subsidiary became an associate or subsidiary became a financial instrument. It could be anything out of this two. Now, this is the pro forma which I was talking about, profit and loss. This you have to know. You start with the disposal proceed, and then fair value of retained interest you have to add, because you are not selling this now, you are retaining it. So whatever the retained interest, let's say 70% you have, out of 70, 30% you have sold. So that 40% is retaining there. Find the fair value and add it to the disposal proceed. Then keep that amount in one side. It will be in the outer column. In the inside column, you will be doing this working. You will be deducting all the goodwill, NCI, net asset of the subsidiary. Okay, so less interest in subsidiary that you has been disposed of. Net asset. Remember, not at the acquisition date, at the disposal date. Net asset of subsidiary, less. Goodwill, less. All these are at the disposal date. NCI also disposal, but NCI you have to deduct from goodwill and net asset inside. Okay, and then bring it to the outer column, the second column. After you get that amount, net asset plus goodwill minus carrying amount, take it outside, deduct it from the amount that you got when you have added your fair value of retained interest with disposal proceed in the outer column. That's why it's with bracket. And finally, the amount that you get, it could be a profit, it could be loss, which is to the group. Presentation of disposal. How do you present a disposal? So if you have acquired a subsidiary to resale it, okay, it is, and if it is classified as held for sale, then IFRS 5 rule you have to apply. Okay, you have first acquired it to sell it, and it also meets the held for sale criteria under IFRS 5. Then how are you going to present it, that subsidiary? So it is presented in the financial statements as a disposal group, which will be classified as held for sale. How are you going to achieve it? By amalgamating all his assets and all his liabilities into another, one by one. All his assets will be in one line, all his liabilities will be on another line. Okay, you add all together. It is measured both on acquisition and a subsequent reporting day. So when you have acquired this subsidiary for the first time, that time also, and when you are now selling it, at that time also, fair value less cost to sell. Because what do you mean by subsequent disposal and held for sale criteria? Held for sale criteria can only happen when you are selling it within 12 months, less than a year. So acquisition date, when you're selling also, both the date, fair value less cost to sell, you are measuring this at the subsidiary. Okay, fair value less cost to sell, because under IFRS 5. Now we are coming to control scenario. Whether we purchase, whether we sell, in step. Control is not loss. One example. Okay, let us first explain purchase, share purchase. 80. Before you were having 80, now you've purchased 5% more, having 85%. So both at 80% also you have control, 85% also you have control. Both the time he was your subsidiary. So what just happened? Your shareholding increased in a subsidiary. That's it. In this, what do you have to do? Just make sure that you go through this well, so that when I explain your disposal, it is just the opposite of it. That's it. Nothing else. Everything is same. Goodwill is not recalculated. You goodwill only once you calculate, when you first bought that 80%, when you first gain that control. Second time, no need to calculate goodwill. Then no profit or loss is calculated, because this is because a purchase didn't take place. This is not known as purchase. This is just the shareholding changed hands. NCI reduced and your shareholding increased. That's it. So how are you going to account for this entry? Debit NCI and credit cash, because you have to pay in cash to purchase that, and debit NCI. Your NCI will reduce. It will fall down. Before you were having 20% NCI, now you are having 15% NCI. And credit or debit, other components of equity. It is taken from other components of equity. You understand? It's a balancing figure. Okay, that means NCR decreased. So you have to find out that decrease in NCR. So decrease in NCR is calculated as the proportionate reduction in its carrying amount. Okay, at the date of the group's additional purchase of share. You have bought 5%. That means it decreased, NCI decreased by 5%. So 5 divided by 20% on the NCI's carrying amount you have to find out. But fraction wise, if you want to find out, it will be 5 divided by 20 because 5% is the change and 20% is before NCI. New NCI plus before NCI. Okay. Now, but definitely calculation and all is there. Under my revision series also you can see the revision kit solution and also my lecture. Coming to disposal part, I can quickly go. Okay. Parents holding is reduced but control is not lost. 80 to 75%. It became 75% from 80. Here, same thing. Goodwill is not calculated. Profit, no profit or loss. Debit cash because you're receiving cash and credit NCI because NCI will increase now when you're disposing. And same balancing figure for other components of equity. Okay. So increase in NCI will be the share of net asset always. And goodwill, fair value method only, of the subsidiary at the date of disposal which the parent has sold to NCI. So if you want to find that increase, take net asset first, add goodwill if fair value method only. Because fair value includes both NCI and the parent's part. That's why. If fair value, add goodwill with net asset and take the percentage of it to find NCI at the date of disposal. Okay, that is known as increase in NCI. But again, as I suggest, please do questions on both the scenario. When you are selling versus when you are purchasing. Under both conditions, you have to do questions. Doing one is not enough to understand the other one. And so that's it for IFRS 3. Before I conclude, these are some other groups accounting standards that you need to go through, that you need to have an understanding in order to do just question number 1, which is for 30 marks. In order to just pass with good marks, your question number 1, you have to go through all these other standards. This is related to group accounting. IFRS 10, consolidated financial statements. Under this, we are going to go through what, whether control is existed or not. Okay, because if control is there, that means it's a subsidiary, you can consolidate. That's it. IS 28, investment in associates and joint venture. I've covered this. If it's an associate and joint venture, use equity method. Okay, IFRS 11, to find out whether it's a joint operation or joint venture. Joint venture, IS 28. Joint operation, IFRS 11. IS 27, separate financial statements. Remember, from consolidated financial statements, you might sometimes have to show the impact on the separate financial statements also. I telling you that there are questions on this as well. Even though the standard is very small, but there have been questions. In the consolidated for separate financial statement, what is the impact in the separate versus consolidated? What is the impact in both the places you should know? IFRS 5. As you can see, we are selling the subsidiary for after we bought it. Or it might be classified as held for sale. For that, we need IFRS 5. The rule of it. IFRS 12. Disclosure of interest in other entities. Whether we are having subsidiary, associate, joint venture, financial instrument, we have to disclose it. Okay. IS 27, statement of cash flow. It is under group accounting when it is a group statement of cash flow. Subsidiaries are having cash flows. How do you account for it? You are buying a subsidiary. What is the impact on the statement of cash flow? You are selling the subsidiary. What is the impact? IS 27. Sorry, IS 21. The effect of changes in foreign exchange rate. When you are having a foreign subsidiary, before you consolidate, you have to first translate using the IS 21 rules. And finally, IFRS 13, which is fair value measurement. It is not heavily used, but you should know fair value measurement impact for all the questions for any standard, not just group accounting, but group accounting, since we have to measure NCI, goodwill, the purchase consideration at fair value. So it's better to know the knowledge of IFRS 13 as well, fair value measurement. So make sure that other than IFRS 3, which is the main branch, it's like an umbrella. And below this, all the standards are there. Go through the standards. Okay, some of this I have uploaded already. Some of this I have yet to upload. Okay, so see you till then, and make sure that you do lots of questions in this area, and next I'm going to cover IFRS 5. Till then, thanks for watching and best of luck for your exam.